Yeah, there's a few key currents. I think looking at the big picture might be important. I think the stock market is getting pretty frothy. If we look at the charts, we'll actually take a look at the big picture and actually go to gold first. So gold, in a nutshell, I'm just going to flip to the monthly chart. Gold has been on a tear, like for a couple of years. It's outperforming. It's becoming one of the best performing assets long term. Last time we saw this was like in 2007, just before a major stock market and financial reset in the economy. Gold is kind of a barometer, a global barometer, like planet Earth and the people on it's like a beehive mentality. The whole world is nervous that something is about to happen, and they tend to move to gold. They move away from equities to some regard. They move away from currencies. They move away from even real estate, and they start to move to gold. They want something physical, something outside of the financial system, and gold is telling us that people are preparing for something bad to happen. We don't know what it is. We don't know, when the shoe is going to fall, and trends are going to change. The economy situation is going to change. But gold has just been on this tear, and it's outperforming, and it's extending to the upside. That is an early warning sign to be careful for the stock market. But if we zoom in now and go to the overall stock market, I'll go to like the SPY, which is the S&P 500 ETF. We've obviously had a very nice rally coming out of the lows from this year. We had a big 20+% sell-off. Now the markets are pushing near hitting all-time highs, camouflaged with. Oracle has now kind of just came out of nowhere. And, Larry, he's like, you never really hear much about him, it seems. Now he's the wealthiest man in the world and he's like silent. And Oracle came out, and I think it's going to revigorate, some of the tech space and make people even more bullish on the market. And of course, it jumped like 30+% the other day. And so the markets are getting dragged up mostly by the big techs. We are seeing some broad market rally. We're seeing small caps. They've been moving up and equal weighted, but it still is really the magnificent seven. And so the stock market is in an uptrend. You do not want to fight it. You just need to have a game plan so that when things do stall out and price starts to roll over, first of all, you can identify when the trend up has come to an end and to have a game plan to at least avoid crash or benefit from falling pricing. And then if we zoom into the shorter term here, Danny, we just look at the 30-minute chart really over the past week, the stock market has gone from this lime green, this oversold market condition where it sold off too quick within this uptrend. Lime green is an indicator, is part of an indicator that tells me when the market is too oversold. Is usually when value hunters step in, bargain hunters or institutions, and they buy it back up, and you can see it's rallied. And it's done this a couple of times. When we just zoom back here on the S&P 500, it can get sold off, it can get into this oversold condition, and it gets bought right back up again. So we're still in kind of that buy the dip mentality. We did have an interesting scenario yesterday where we had this red indicator, get above this blue line. This is my FOMO indicator. This is when there's a ratio and this red indicator goes over 3, it's telling me that people are just moving in and they believe the market's going higher and they don't want to be left behind. And so usually after that, we have a little bit of a pause or pullback. And really, it's kind of, as soon as we got up into that territory, the market's really been trading sideways for this last day and a half. We might actually see it pull back a little bit for another day or so. So, you look at long-term gold, be aware the music will come to an end at some point. We look at the daily chart. It's up, but it's a very weak market. Yes, the market's going higher, but there's not a lot powering it to go higher. Utilities is actually a really good point of view that people should watch. If we look at utilities, when utilities have a very strong move to the upside, like we're seeing in the past week, last time we saw this was going into August, utilities shot higher, and then the market went into a correction. So when utilities outperform the S&P 500, it's kind of like gold in a way that people move to utility stocks because they pay dividends. And it doesn't matter how bad the economy gets, you still need electricity and running water. So these companies aren't going out of business. So when utility stocks start to perform really well, which they've been doing just recently, if we look at that same time on the S&P 500, the S&P 500 went sideways when utility stocks shot higher. And then we had a bit of a hiccup. So we're in the same scenario where I think, the short-term FOMO chart I just showed you says, hey, we might see a little bit of a pause or pullback within this uptrend before it wants to push higher. There's multiple time frames in there. You need a game plan for if the music stops and we go into a financial reset. You need to know that we're about ready for a little bit of a pause or pullback. And then on a short-term basis, it's telling us if, we might see that this coming week, a 1 or 2 day minor pause or pullback. Nothing here is screaming anything serious. It's really, you got to ride this trend. We're long the equities market and you want to ride this higher at this point. So if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had a very strong move. And after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening. It's just taking a breather because it just had a hell of a run. It's exhausted. There's just some profit taking. And so even when we look at the daily chart, which is very similar, we're just trading sideways. And it's a little tiny bull flag. It's primed and ready to shoot up literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. And I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold. And gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. It flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here.
And so that's how you're playing it. You're exiting out of the silver miners. Am I correct in presuming that you're allocating that capital or a portion of that capital back into gold, or
we actually own both. We were in silver miners. We've closed them out because we've hit our max target that satisfies that strategy. We're still long gold. We actually own both of them because you don't know which one's going to outperform, and they're both kind of the same play. So you can take advantage of both, split your capital, or you can pick one if you want. But miners and gold, you never know which one's going to take off. So I like kind of both. And gold to me has the highest win rate. When there's a trade setup, it wins most of the time. So I like to have a sure bet in there almost. And then the miners are the more speculative play.
Understood. What about silver?
Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver's breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. These are very nuanced, small moves. But silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver and shoot higher, very similar to what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. But yeah, right now we're in that sweet spot for precious metals. And you and I have touched on this cycle graph before. If we look at the stock market, this blue cycle here, precious metals really come to life near a major market top. And one of the reasons is people are moving away from the stock market in general, and they're moving into physical assets, something where they won't lose value or won't blow up on them as much. And industrial capital goods are actually doing really well. When we look at the industrial space, businesses are still bullish, and industrial stocks are rocketing higher. Businesses think things are good. CEOs and factory workers or management are upgrading their facilities, thinking this is a little lull maybe for a lot of businesses before it goes higher. But I think the music's about to end, and when everybody's really bullish and they think businesses is just getting started, usually that's when the business goes for a nosedive. We go in for a recession, and they realize they just spent millions on new facilities or assembly lines and all that stuff right when all their demand decreases. So there's a lot of things coming together. And to loop kind of back one more step about where we are in this cycle, Danny, is if we actually look at the economy and the business cycle, which is the yellow cycle, and it's lagged. It usually will top out after the stock market. We're in this innovation and adaptation phase, which is right near a stock market top when you look at the blue cycle. And AI is the innovation this wave. It is dragging and driving the equities markets higher. Everybody's putting it in and everybody's excited. And so I think this is that last kind of real push to the upside. No one knows how high the market's going to go. Bubbles and overvalued stocks can keep going for a very long time. So just because I'm bearish doesn't mean you start focusing on buying inverse ETFs by any means. You stay long this market. But we need to know, everything is telling us from my analysis and the way I view the markets, that you better have a game plan ready, because when the time comes, you're gonna get your wealth probably wiped in half if you're in the equities market. So you just have to be very cautious. So those are all the layers to the onion, more or less, that I see unfolding. I think if rates are getting cut, then people are going to want to go somewhere where they can make more money, which means move away from fixed income and take on risk, move to the stock market. Short term, I think it's good for stocks. It's also good for bonds. Falling rates, we should see the bond market take off. And if we were to actually, just look at TLT, which is the long-term treasury bond, and we'll just go back to the daily chart here. You can see bonds in the last week and a half have just popped and really taken off. Everybody's expecting a quarter or a half basis rate cut. And as rates go down, bonds go up. And when you zoom out on the bond market, you can see, we're still very much so, in a bear market. It peaked out in COVID. And ever since then, we've just been seeing, more or less Rates go up and bonds have been going down. And finally, the rates may stall out. And that's why I think bonds are flatlining here, trying to find a bottom, a base. And I think it's still early trying to get into bonds right now. I still think you're picking a bottom and it might not be in yet, or it still could trade sideways for another year or so. So it's kind of still dead money. I'll be looking for bonds to really have a big leg up and for this downward bias and this sideward bias to shift upward. And then I'll be looking at bonds. It's not about can you buy something at a low, at a bottom. It's like, can you buy something when it's in an uptrend? So when you get into it, it's consistently moving up in your favor versus hoping it bottomed. And then it doesn't. And then you waste years with no return or suffer drawdown. So I think if rates start falling, bonds could become a very good opportunity. And it'll also short-term help the stock market. But at some point, rate cuts happen because the economy's weak and the Fed's trying to save businesses and all that. But there'll be too much selling in the stock market, too much fear, too much weakness, that rate cuts will maybe give a short-term pop in the stock market, but it'll fizzle right back out and stocks continue to go down. So rate cuts are just a very short-term, kind of usually a blip on the chart. And how the markets react, will vary depending where you are in the market state.